The Warren Buffett Way, Investment Strategies of the World's Greatest Investor by Robert Hagstrom. Key takeaways. Number 1. Invest in businesses, not stocks. Understand the company behind the ticker. I am a better investor because I am a businessman, and a better businessman because I am an investor. Think like a business owner. When evaluating potential investments, Warren Buffett looks beyond stock prices and financial ratios. He analyzes the underlying business, its products, competitive advantages, and long-term prospects. This approach helps investors make more informed decisions based on a company's fundamental value rather than short-term market sentiment. To adopt this mindset, study the company's business model and revenue sources, analyze industry dynamics and competitive positioning, evaluate the company's ability to generate consistent cash flows, consider the company's growth potential and barriers to entry. By thinking like a business owner, investors can better understand the true value of their investments and make decisions based on long-term business performance rather than short-term price fluctuations. Number 2. Focus on companies with consistent performance and favorable long-term prospects. Time is the friend of the wonderful company, the enemy of the mediocre. Seek enduring excellence. Buffett favors companies with a long history of consistent performance and strong potential for future growth. These businesses typically have a simple and understandable business model, a consistent operating history, favorable long-term prospects, a durable competitive advantage, economic moat. Examples of such companies in Buffett's portfolio include Coca-Cola, American Express, and See's Candies. These businesses have demonstrated their ability to generate profits and maintain market leadership over extended periods, even in challenging economic conditions. By focusing on companies with proven track records and sustainable competitive advantages, investors can increase their chances of long-term success and reduce the risk of permanent capital loss. Number 3. Prioritize management integrity and rational capital allocation. Managers that always promise to make the numbers will at some point make up the numbers. Character matters. Buffett places great importance on the integrity and competence of a company's management team. He looks for executives who act with honesty and transparency, communicate candidly with shareholders, allocate capital rationally, resist the institutional imperative, blindly following industry trends. To assess management quality, read annual reports and shareholder letters. Analyze capital allocation decisions and their outcomes. Evaluate executive compensation structures. Look for consistent delivery on promises and goals. Investing in companies led by trustworthy and capable managers increases the likelihood of long-term success and helps protect against fraud and mismanagement. Number 4. Analyze financial tenets, return on equity, owner earnings, and profit margins. The primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed. Focus on key metrics. Buffett emphasizes several financial indicators to evaluate a company's economic performance. 1. Return on equity, ROE, measures how efficiently a company uses shareholders' equity to generate profits. 2. Owner earnings, net income plus depreciation, depletion, and amortization, less capital expenditures and working capital needs. 3. Profit margins indicate a company's pricing power and operational efficiency. Other important financial considerations include consistent earnings growth, low debt levels, high free cash flow generation. By analyzing these financial tenets, investors can identify companies with strong economic fundamentals and the potential for sustained value creation. Number 5. Buy at a significant discount to intrinsic value for a margin of safety. Price is what you pay. Value is what you get. Seek bargains. Buffett emphasizes the importance of buying stocks at a significant discount to their intrinsic value, providing a margin of safety. This approach helps protect against downside risk and enhances potential returns. To determine intrinsic value, 1. Estimate future cash flows. 2. Apply an appropriate discount rate. 3. Consider qualitative factors like brand strength and competitive position. The margin of safety concept provides a cushion against errors in valuation or unexpected events, increases the likelihood of achieving satisfactory returns, reduces the risk of permanent capital loss. By consistently applying this principle, investors can improve their odds of success and protect their capital during market downturns. Number 6. Concentrate investments in a few outstanding companies you understand well. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Focus your portfolio. Buffett advocates for a concentrated investment approach, focusing on a small number of high-quality companies that fall within an investor's circle of competence. This strategy allows for deep understanding of each investment, higher conviction in investment decisions, potential for outsized returns. Benefits of concentration: ability to closely monitor each holding, reduced impact of mediocre investments on overall returns, forced discipline in stock selection. While this approach may increase short-term volatility, it can lead to superior long-term results for investors who have done thorough research and maintain a long-term perspective. Number 7. Maintain emotional discipline. Be fearful when others are greedy and greedy when others are fearful. The most important quality for an investor is temperament, not intellect. Master your emotions. Buffett emphasizes the importance of maintaining emotional discipline in investing. This means avoiding the herd mentality, remaining calm during market volatility, making rational decisions based on fundamentals, not emotions. Strategies for emotional discipline: develop a clear investment philosophy and stick to it. Focus on long-term business performance, not short-term price movements. Use market downturns as opportunities to buy quality companies at discounted prices. By mastering their emotions, investors can avoid common pitfalls like panic selling during market crashes or chasing overvalued stocks during bull markets. Number 8. Ignore short-term market fluctuations and economic forecasts. I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. Think long-term. Buffett advises investors to ignore short-term market noise and economic predictions, which are often unreliable and can lead to poor decision-making. Instead, focus on the long-term prospects of individual businesses, fundamental analysis of company financials and competitive position, identifying durable competitive advantages. Benefits of this approach: reduced trading activity and lower transaction costs, improve tax efficiency through long-term capital gains, less stress and emotional decision-making. By adopting a long-term perspective, investors can avoid the pitfalls of market timing and benefit from the compounding of high-quality businesses over time. Number 9. Practice patience and low portfolio turnover for tax efficiency and compounding. Our favorite holding period is forever. Let your winners run. Buffett advocates for a low turnover approach to investing, which offers several advantages. 1. Tax efficiency. Deferring capital gains taxes allows investments to compound more effectively. 2. Reduced transaction costs. Less frequent trading minimizes brokerage fees and market impact. 3. Compounding of business value. Holding great companies for extended periods allows investors to benefit from their long-term growth. Strategies for implementing this approach: conduct thorough research before making investments. Focus on high-quality businesses with durable competitive advantages. Resist the urge to sell based on short-term price movements or market sentiment. By practicing patience and maintaining a low-turnover portfolio, investors can maximize the power of compounding and minimize the drag of taxes and transaction costs on their returns. Number 10, expand your circle of competence to identify opportunities across industries. What an investor needs is the ability to correctly evaluate selected businesses. Note that word selected. You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. Continuous learning. While Buffett emphasizes investing within one circle of competence, he also encourages investors to expand their knowledge base over time. This allows for identification of new investment opportunities, better understanding of evolving industries and business models, adaptation to changing market conditions. Ways to expand your circle of competence. Read extensively about various industries and businesses. Study annual reports and financial statements of different companies. Attend industry conferences and shareholder meetings. Engage in discussions with experts and fellow investors. By continuously expanding their knowledge and skills, investors can adapt to changing market conditions and identify new opportunities for long-term wealth creation.